Welcome to vTalkInsight, Market Drivers Daily for May 27th, 2026. AI spending is powering record equity levels just as stagflation fears in U.S. Iran tensions return to the foreground, setting up a critical test for risk assets. Let us start with how the AI trend is reshaping growth, inflation, and market structure. Across macro and micro data, artificial intelligence has moved from side story to central growth engine, even as concerns build that the equity rally around it may be running ahead of fundamentals. Earlier this week, we highlighted AI as the main offset to energy and rates headwinds, and that remains true today, but the picture has sharpened around productivity, inflation, and leverage. On the upside, AI-related capital spending is now a major contributor to economic growth, with investment and equipment outlays increasingly tied to data centers and model training. S&P 500 earnings are projected to grow roughly 24% this year and 13% next, and AI-linked capex is cited as a key reason why higher equity valuations are still being tolerated. A Fed study suggesting potential productivity gains of 15 to 30% from AI hints at a meaningful positive supply shock, which could support stronger long-term growth, even if it ultimately pushes the central bank toward a more restrictive stance. That macro story is feeding directly into profits. 7 of 11 S&P sectors are already seeing margin expansion linked to AI efficiencies, from automation in back offices to smarter inventory and pricing tools. Financial services are a clear example, with firms like J.P. Morgan deploying dozens of substantial AI use cases and using alternative data to hunt for new alpha streams, even as they juggle higher compute and token costs. At the same time, AI infrastructure spending is booming. Hyperscalers are committing to major capacity builds, including gigawatt-scale data centers, while memory chip makers face structural undersupply that is expected to keep pricing elevated for the next 1 to 2 years. Set against that, the risks around how AI is being financed and adopted are becoming harder to ignore. Memory shortages tied to AI data center demand are estimated to add about 0.5 percentage point to core PCE inflation this year, and geopolitical frictions could amplify that effect. On the corporate side, many enterprises are discovering that utilization-based AI tools are more expensive than expected, which is accelerating a shift toward outcome-based pricing that may compress traditional software and outsourcing margins. Legacy platforms like Salesforce and other large SaaS vendors still benefit from trust and data control, but they face a clear prove-it period as growth lags, key executives depart, and investors question how quickly AI agents can be monetized. Underneath the headline earnings strength, there are signs of excess and fragility. Some retirees are reportedly using margin and AI-driven trading tools, including new offerings that let external AI agents trade retail brokerage accounts, raising both operational and regulatory questions. Private credit funds with exposure to risky tech loans and AI-disrupted business models are seeing rising demand for redemptions, with at least one large manager imposing withdrawal limits, which points to stress building away from public markets. At the same time, enterprise adoption of agentic AI remains cautious. Most large organizations are keeping humans firmly in the loop for critical processes, which tempers near-term revenue upside for vendors but may reduce the risk of costly implementation missteps. Looking ahead, the key question is whether productivity and margin gains can scale fast enough to justify today's AI premium before credit strains, higher inflation from chip bottlenecks, or regulatory backlash bite. Evidence to watch includes whether AI-driven margin expansion spreads beyond the current group of sectors, how quickly slower-moving software incumbents can turn vision into revenue, and the pace at which mega AI IPOs concentrate index exposure further. In summary, AI remains the dominant growth driver, but the mix of retail leverage, business model disruption, and inflation spillovers makes the distribution of outcomes much wider than headline earnings forecasts suggest. Those tensions are showing up very clearly in the way the tech-heavy parts of the tape are trading. Equity indices are pressing deeper into record territory, but the path up is increasingly dominated by a small group of AI and semiconductor names. The S&P 500 has closed at new highs for 5 consecutive sessions, while emerging market benchmarks have outperformed, led by strong gains in Asian chipmakers. In Korea, for example, The Kospi index jumped about 4% on the day, even though roughly 4 out of 5 constituents declined, underscoring just how concentrated this advance has become. Semiconductors are at the heart of this leadership. Memory producers are enjoying structurally tight supply and strong AI-driven demand, with pricing power expected to last at least the next 12 to 24 months. One major memory name has vaulted from around $500 billion to $1 trillion in market value in little more than 6 weeks, far outpacing the earlier ascent of leading GPU suppliers and highlighting intense momentum in the space. Despite those price moves, forward earnings multiples for several memory players remain in the high single digits, as investors increasingly treat them as structural AI beneficiaries rather than purely cyclical trades. Earnings have so far validated much of this rally. Asia-Pacific technology earnings grew about 130% year-on-year in the first quarter, even as consumer discretionary profits in the region shrank. Within U.S. software, infrastructure platforms are pulling away from the pack. Snowflake, for example, delivered strong results and announced a $6 billion multi-year chip purchase agreement with a major cloud provider, fueling a jump of more than 30% in the share price and cementing its role at the center of the AI data build-out. By contrast, application vendors such as Salesforce are in a tougher spot, with slowing organic growth, cautious guidance, and investor doubts about the timing and scale of AI monetization. Market structure is amplifying these trends. Nasdaq has now overtaken the New York Stock Exchange in total market value, hosts 9 of the 10 largest listed companies, and continues to attract heavyweight listings, including established retailers moving their primary quote. The Nasdaq 100 does not require profitability for inclusion, which means future mega IPOs in areas such as space, foundation models, and frontier AI could join the index before they generate consistent earnings, potentially lifting AI exposure in major benchmarks by 6 to 7 percentage points. There is also a robust pipeline of billion-dollar offerings across defense tech, AI, healthcare, and consumer sectors. Historically, heavy IPO calendars have sometimes foreshadowed market peaks, but today that caution sits alongside strong macro growth, broad earnings upgrades, and a powerful wealth effect as AI and chip gains bolster spending by older, asset-rich households. The tension for equity allocators is that, while headline valuations still look reasonable relative to earnings, a larger share of day-to-day price action is being driven by momentum, retail participation, and fear of missing out. Rapid share price gains in favored tech names now reflect both higher earnings and multiple expansion, as investors reassess the cyclicality of semiconductors and the durability of AI infrastructure demand. At the same time, banks and several lagging software names have not kept pace, despite clear potential to benefit from AI financing needs and operational efficiency, which points to meaningful dispersion under the surface. From here, the durability of the tech-led rally will hinge on whether the next few earnings seasons in chips and AI infrastructure can keep surprising to the upside, and whether leadership broadens beyond today's narrow cohort. Watch for confirmation that memory pricing stays firm, that mega-cap tech continues to translate AI investment into cash flow, and that upcoming AI-heavy IPOs are absorbed without destabilizing existing winners. In sum, the tape still reflects a fundamentally supported but increasingly concentrated advance whose sensitivity to any shock, especially on the macro or geopolitical side, is rising. That brings us to how the evolving U.S.-Iran story is feeding into energy, inflation, and volatility expectations. The geopolitical backdrop remains dominated by negotiations between the United States and Iran, particularly around the Strait of Hormuz, and the message for markets is anything but clear. Reports of a potential memorandum of understanding and a draft deal to restore shipping flows within about a month have pulled oil prices lower and encouraged talk of reduced supply risk. However, U.S. officials have denied that any agreement is in place and have pushed back on suggestions of imminent sanctions relief or the unfreezing of Iranian funds, leaving a wide gap between optimistic headlines and hard policy. Key sticking points remain unresolved. Control over the strait itself, including Iranian proposals to charge ships for passage, the management of frozen assets, and oversight of Iran's nuclear program are all still on the table. The U.S. administration has signaled it is prepared to escalate pressure quickly if Iran fails to comply with its demands, and the president has been explicit about discomfort with Russia or China gaining access to highly enriched Iranian uranium. Compared with the structural disruption and vessel queues we discussed earlier this week, current market pricing looks more relaxed. Crude has fallen sharply, by around 4.5% in recent sessions, even though negotiations could yet break down or deliver only partial relief. The macro risk is that this conflict feeds into a stagflationary backdrop that is not fully reflected in equity prices. Persistent geopolitical tension is already flagged as a driver of stickier inflation and slower growth, which could weigh on stocks beyond what is currently discounted. Energy is not the only channel. Supply shortages in AI-related memory chips are estimated to add roughly 0.5 percentage point to core PCE inflation this year. So an energy shock layered on top of tech-driven cost pressures would challenge the existing higher for longer rate narrative. Yet, for now, equity markets have been resilient, with dips around geopolitical headlines being bought and implied volatility remaining relatively subdued. There are also market structure angles to this story. The SEC's move toward 23-hour, 5-day equity trading raises the prospect of thinner liquidity and sharper overnight moves when geopolitical news breaks, even as some investors respond by lifting cash allocations to around 7% as a buffer while keeping cyclical exposure. Separately, the CFTC's authority to restrict certain war and terrorism-linked contracts sits alongside ongoing legal debates about the broader event contract space, which could shape how participants hedge binary geopolitical outcomes. Looking ahead, the critical signals will be actual shipping volumes through Hormuz, any jointly announced and verifiable agreement between Washington and Tehran, and how quickly any energy or inflation shock shows up in data. In brief, markets are trading as though a benign resolution is more likely than not, but the combination of unresolved nuclear issues, sanctions uncertainty, and extended trading hours means the volatility risk skew from geopolitics remains firmly to the upside. To pull this together, AI continues to drive capex, productivity, and earnings upgrades, but is also contributing to narrower market leadership, new forms of leverage, and fresh inflation pressures. The tech-led rally still rests on strong profit growth in semiconductors and AI infrastructure. Yet breadth is thinning and index structures are concentrating risk into a small group of names just as a heavy IPO calendar approaches. On the macro side, conflicting signals from U.S., Iran talks, and unresolved questions around the Strait of Hormuz keep a stagflation and volatility tail in play, even though recent price action suggests a more benign outcome is being priced. Monitoring how quickly AI benefits feed through to cash flows, how broad the equity advance really is beneath the surface, and whether geopolitics start to show up more forcefully in inflation data will be key for framing scenario ranges over the coming months. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.